This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachordiz. Thanks for joining us at xm.com. The US dollar spent most of this month on the ropes, pressured by signs that inflation is simmering down and speculation that the Fed is in the final chapters of its tightening cycle. Yet the reserve currency came back swinging on Monday, regaining lost ground with some help from safe haven flows. Hopes that China will relax its COVID strategy were crushed over the weekend after the government tightened restrictions in some major cities to deal with rising caseloads. Hence, the notion of a paradigm shift in China seems to have been premature, especially since the recent rescue package for the embattled property sector did not include enough firepower to turn the tide. With bets around an imminent Chinese reopening being unwound, a wave of risk aversion swept through global markets. In the FX arena, the currencies that retreated the most were those with high economic exposure to China or a tight correlation to global risk sentiment, such as the Australian and Canadian dollars. Across the risk spectrum, the US dollar was the main beneficiary. Another crucial week lies ahead, featuring the minutes of the latest Fed meeting and the S&P Global Business Surveys on Wednesday. It was a hellish week for crude oil, which suffered heavy losses as demand concerns overshadowed some encouraging supply signs. The outlook for global fuel demand continues to deteriorate, with China's intensifying COVID outbreaks and nearly every piece of incoming data pointing to a recession in the Eurozone and United Kingdom. On the supply side, even though OPEC has announced plans to slash production, it was not enough to nullify the prospect of demand destruction. Staying in the commodity sphere, gold prices are on the retreat, surrendering some of the gains they recorded after U.S. inflation clocked in below expectations. The trading dynamics governing gold shifted this year, with bullion forfeiting its traditional safe haven qualities and turning into a mirror reflection of the US dollar and real yields. Stock markets traded sideways last week as equity traders sifted through a mountain of clues to decide whether the latest recovery was just another bear market rally or the early phase of a reversal. There's a real dichotomy between the equity and bond markets. While stock market valuations and earnings estimates are more consistent with a soft economic landing, the dramatic inversion of the entire yield curve suggests bond traders expect the economy to hit a wall soon. This was today's Daily Market Comment. Thanks for joining us at xm.com.